Good afternoon, ladies and gentlemen. Nice to be here again. We have a presentation which will be up on the website, and we're starting off here with financial results for the first half of the year. There are some excellent results embedded within this, and although we're showing an operating loss of around about 185,000 versus 62k profit last year, that is made up of some very definite articles which, if wound out, such as the cost of running the French operation, the pilot, we'd get to around about a similar sort of place as we were this time last year. The biggest issue for us obviously is that we wanted to give forward guidance, and I'll be talking about that a little bit more as well. So overall gross revenues 11.1 million versus 11.3, and net revenue 4.6 versus 4.7, and as I said, operating loss of 185 versus 62, but I can explain all of that as we go along. The operational highlights of the business is that in October last year we started with the Network Rail portfolio. That was a 5-year contract, and the contract was predicated on all of the major mainline railway stations in and around London. As it happens, due to overhaul of notably London Bridge and Paddington, we haven't been able to operate in those two locations. They'll be freeing up in Q4 this year, and we have had a very strong start with Network Rail, beating ours and their expectations. We have been operating 75 MPKs, up from 32 on last year, and the programme will get to 80 this year, and we'll be looking at how many we want to put in 2017. We've done a pilot which is operating in France with Auchan. That started in January, and we are meeting with them tomorrow to see how we want to progress the pilot into a full-scale operation with the French business, or is it a hybrid, or does it not work for all of us? But obviously the biggest thing that we did in the first half was we took the decision to close S&P+, and had a one-off charge of £500,000+. This is due to inefficient prospects in their sales pipeline. They were working on two very, very large projects which fell over at the last minute, and that would have meant that Q3 would have been very tough for them, and that they would have been massively over the level at which we were willing to go in the form of lending to them. So we took the difficult decision of closing S&P+, and as I said, that's created a one-off charge of £550,000. I want to split the business out into its various regional divisions. UK performance is up 5.4%. A lot of this is down to the drive of the Network Rail contract. It's the increase is not as great as we'd anticipated overall, primarily because the Network Rail contract sucked in so many of the staff that we've had a downturn in business into our existing shopping centre estate. We have put things in place such as recruiting more staff, putting incentives in place to enable staff to get a fair crack at the whip for commission in all of our estate, and we see that coming back in the second half of the year. MPKs were a very strong aspect of this business. We're putting it under the retail revenue because of the way in which you recognise the revenue, but MPK is going from 32 to 75. I think this time last year we were on £450,000 of sales to the end of September. This year we are on 1.2 million, and by the end of the year we anticipate being on 1.5 to 1.6 million versus 660,000 last year. So we can see that there's massive traction for the MPK project. Average revenue per unit has gone from £13,000 per unit to £17,000 this year. And if we do not roll out any more than the 80 units planned next year, but have a full year utilisation at the current occupancy rates, we can easily see an improvement of gross sales by around about 100,000, net sales of around about £100,000 without rolling out any more. Been very well received, and we are trialling new industries such as the field marketing industry, looking at utilising these for sampling exercises in shopping centres and railway stations. Big drag on our performance has been in Germany. In the promotional revenues down 11%. This is due to long-term contracts which we'd signed with telecoms operators for taking MAL space. We recognised the revenue over 3 years. They came to an end this year and are not being renewed. Although long-term promotional profit is down, short-term promotional profit sales were up. However, their contract with their key client MEC ends this year, and although we have seen the contract and we are happy with the contract has not yet been signed. That will be resolved imminently. Retail revenues down, although last year we signed a 2-year extension with ECE, and we reduced the number of units on the ground. Unfortunately, there has been slippage and greater retail slippage in that particular portfolio. There were 3 cash cows last year, 3 cash cow units in Dresden, in Munich and in Essen. Those 3 things are the biggest component of that downfall. We are negotiating a rent review for the last 4 months of the year. And we have started the negotiation for an extension of the RMU programme in Germany post 2017. And we will update the market as we get more information. Throughout the year we've been able to strip out head office costs, mainly due to lower salaries, and next year we have a programme of reducing head office costs through natural wastage by improving our software systems and by going to the iCloud. So we've got server renewals. So there's some potential savings that we'll be initiating for 2017, and obviously we've got the costs of Emotion, which are currently about 90,000 for the year, about 150.
About 120,000 for the full year.
120,000 for the full year. But as we said, we are meeting Emotion tomorrow to decide whether or not we wish to go ahead with a refined proposal that we've created, with a hybrid proposal which we created, or with let's stop it. So the rest of the year is the continued rollout of the MPKs. We've been operating at around about an aggregate 59% occupancy rate this year. That's lower than we wanted and anticipated. So the big drive is for improvement of occupancy in these particular units. Occupancy is down because we had only 2 people selling these units for 4 months of the year. We have recruited new staff. We've recruited them well, and they're bedding in well. And sales so far for September have been a record for the MPK programme. So we're back on track with that, but we won't be making up the slippage for the previous months. So there will be a slight shortfall in overall revenue due to occupancy. The pop-up kiosk initiative, last year we rolled out 29 of these units. Historically, the RMU programme has been based upon long-term retail contracts in long-term locations with shopping centres. A big rump of that business has changed. A big rump of that business that wants to be in shopping centres, but they want to be just in for the high point, the strategically important parts of the year, Christmas and Easter. So we had around 50 or 60 of these units gathering dust in the warehouse. We've got a logistics team and a sales team. All we needed to do was create an operational framework which allowed operators to take over these units just November to mid-Jan. So rather than having these units on the mall or in a warehouse, we just bring them out, for November to January. It's a fixed price, and they've also got to pay for delivery of these units. We help with merchandising, and it's a 50-50 with the shopping centres, no minimum guarantee, and we aim to be between 60 and 80 in operation for this year. We really see that pop-up just-in-time kiosks is going to be a big driver. Once we can refine it, we'll learn even more this year, and we'll take our expertise into the next year. There's no CapEx involvement in this. All of these units are already being pretty much fully depreciated. It's about how can we generate revenue and meet customer expectation regarding contract flexibility. So that's the big key focus for us. We've got the critical months. We're always back end of the year orientated. However, all departments are giving me good sales pipelines to see the run into the end of the year. However, it's never done until it's done. So, you know, as everybody involved in any sale operation themselves know, there's always a moment of holding your breath. And as I said, tomorrow we're meeting Auchan regarding what do we want to do regarding the French pilot. We've been operating in 5 shopping centres. What's been difficult is that when we went to France, we thought there would be a reservoir of users that would want to utilise this particular unit, people who'd traditionally been in the shopping centre but used beach flags and old decorators' tables to present from. But unfortunately, those people aren't there, so we're having to start at ground zero. Good news is 2 of the units have been operating very, very strongly at 90% and 80% occupancy. 2 have been absolute dead ducks, and we don't know why, primarily because when we look at the demographic profile of the catchment area and we look at average spend in the hypermarket, they are very, very similar. And one has been spluttering. When I'm looking at it, the run into the end of Christmas, sales are improving, that we're taking bookings for next year, but is it enough for Auchan? Is it enough for us? We have got contingency plans. We want it to work, but it has to be on more favourable terms. So overall, I know a lot of people have been selling off the stock, and they're probably worried about the fact that we announced that for the first time ever. We mentioned the D word in a forecast, and that we wouldn't be paying a dividend next year. As most shareholders are aware, Nancy, Cullen and I, as co-founders and senior management, are the biggest shareholders, so we live for the dividend. So I can anticipate there's a sharp intake of breath. But the bottom line is, we felt it was the prudent thing to do to conserve cash so that we can enable the expansion of the MPK programme next year. And that we have the financial headroom that we don't have to go cap in hand to the bank. We have an ongoing good relationship with our bank, and Gregor can talk about that a little bit more. We had a meeting with them yesterday. They are very supportive, and we anticipate there being no issues with that moving forward. So we see there being a 1-year holiday in the dividend payment. We see some of the old cash cows getting rheumatism a bit stronger than we'd anticipated, but we do have the new products and the new shooting stars, such as MPK and just-in-time pop-up, as going to be real drivers for the business. That and opening up of more network rail shopping centres next year without an increase of the minimum guarantee, increasing the number of spaces. We think that next year is going to be quite vibrant for us as a company. That's really the presentation. The company's not going bust. Nancy and I are very happy with the way in which the things that we put in place are going to develop next year. Really, it's I'm not sitting here worried about the company or worried about things. Most of this is down to, as we said, one-off costs relating to the closure of SpaceandPeople Plus, the running of the French pilot, and a couple of other things which are one-off costs, which are not too huge, but are to do with gardening leave and redundancy for an ex-member of staff. None of these costs will continue, so we are happy that we've cleared the field, cleared the air, and we're moving forward with the business in 17 and 18. Thank you very much. Over to questions, I suppose.
Indeed. Thank you, Matthew. We have a number of questions already, and I'd remind listeners, viewers, that they can submit more. Gregor, first question for you.
Yes.
Just in terms of the company's cash flow and the hopefully one-off difficulties that you've reported in the trading environment recently, as Matthew mentioned, Christmas trading is a very important period for you. So Ashraf is curious whether you are comfortable that you have sufficient cash to invest and leverage the potential volumes available at Christmas.
Yeah. We are traditionally a back half loaded company in terms of our cash flow. We have historically spent money in the first half year just supporting the company, paying the dividend, paying taxation, and then in the second half year that's become cash positive as we have sold more in the second half year and collected that income as we make the sales. We have been cash negative on a net basis at the half year end, and we anticipate being cash positive on a net cash basis at the year end, in addition to having the £2 million facility that we have with Lloyds. A lot of the trading, in fact all of the trading that we have to do in the second half year is based on assets and staff that we currently have. We have no additional cash investment in order to be able to make those sales. And in terms of next year, we will be looking to purchase some more MPKs, but other than that, on the pop-up units, etc., we already have the assets that are required to do that. CapEx next year we anticipate being in the region of about £300,000 to £400,000, which would be CapEx on MPKs and also on some system developments on our UK CRM system. But next year, again, especially with the suspension of the dividend, will be cash positive, and we anticipate no cash problems at all.
Great, thank you very much for that. Question probably for both of you from Hamish. Matthew, you're referring to one or two disappointing occupancy rates on MPKs. How do you look at the decision to perhaps lower price and lower margin versus boosting those occupancy rates?
We have got the flexibility of changing the price and on the MPK. That's one of the wonderful things about it, is we own the unit, so we can flex pricing. But the problem is not about demand, it's about resource allocation of staff to actually go and make those sales. We have fixed that problem. For most of the first half of the year we were operating with 2 members of staff only. It's now up to 6, is it, Gregor? Plus
yes.
A manager. Six sales people plus a manager. You've got to remember that the MPK is on almost double the margin of our historical business. So although we're saying 1.6 million, it's actually much more lucrative than our traditional business. So to answer your question, the issue is not price inelasticity, it's about having enough staff in the office to actually go and capture the business.
Okay, very clear. There were a couple of questions relating to the broader picture of retailing, and whether you could use your considerable opinion and experience to opine on whether people are changing their shopping habits, whether the growth in online shopping is affecting traffic at shopping malls, whether people are deciding what they're going to buy before visiting the shops, and what implications there are for the longer term future of shopping centres and therefore a lot of your promotional work, or whether this is just a passing change in fashion that you are confident the mall operators will cope with.
It's changing. It's always, in fact, the plate tectonics of the property world are changing very, very rapidly. If I tell you that now, I think that this year we'll anticipate that almost half of our business will be generated in non-shopping centre locations, such as railway stations, such as garden centres, such as outdoor retail parks. and that has been one of our biggest growth areas. And we've taken Network Rail for nothing to being one of our largest clients, and we think we're only touching around about 50% of the potential capacity. We can see that we are called Space and People, not Shopping Centres and People. That we've always seen that shopping centres were going to be a foundation of the business. However, the business is changing. If you look at footfall in shopping centres, irrespective of what's going on in the greater economy, short of there being terrible weather or a price spike in petrol, footfall in shopping centres is generally pretty static, and there is a long-term trend for deterioration, but that's probably because there is greater opportunity to shop in other locations, not just online. But if you look at the way in which shopping centres have evolved very quickly, the shopping centres are now predominantly a food offer, predominantly an entertainment offer, with one or two big anchors such as a John Lewis. So what we are selling, remember, is access to consumers. That's what Space and People does. Whether or not they buy anything or not in a shopping centre, to us is not material to the effectiveness of whether or not a brand would wish to communicate with those people. So although the actual element is changing, we are ahead of the market on this. We are driving the agenda, so we see next year that retailing, short-term retailing will be short-term food retailing. We are in negotiation with a lot of our property developers to really push the pedal to the metal on that, whether it be Network Rail, British Land or Land Securities. We see that there being outdoor temporary pop-up units for street food is going to be quite a big business next year. And we see that the whole change of shopping habits will not change the footfall habits of key locations, whether they be airports, railway stations, shopping centres or garden centres.
Great, very informative answer. Last couple of questions coming from Liam. Again, in terms of the changing business mix, would it be fair to say that visibility of your business has changed and perhaps shortened in the last couple of years? And then secondly, could you just delve a little bit more into the potential of Network Rail contract that you referred to and how long it might take for you to reach peak earnings potential from it?
Okay, Network Rail, we started with 15, was it?
15 stations,
15
mainline
stations, mainline stations, of which a number of those mainline stations have not been able to utilise, such as London Bridge, Paddington, any others, Gregor?
We haven't really utilised Blackfriars.
No, quite. But they are coming on stream. One of the things that Network Rail liked about us as a company when we pitched for the business was we saw them as destinations in their own right. That photograph on the front page is an MPK at King's Cross Station. You think it looks like a shopping centre, and it's predominantly that we saw their railway stations not as railway stations but as destinations in their own right. Network Rail PR'd the fact that something like a third of the footfall in King's Cross now are not there to travel, they are there for the food and the retail offer. So we struck a chime with them as to how we can utilise space as much as possible. This picture here shows the Renault Clio, showing 25 years of the Renault Clio. This is on outdoor space at King's Cross. Big deal, where's that? Well, they'd never utilised that space before. We came to them with a proposal, challenged them as to the use, why it can't be used, and we've now created more space. This is going to happen more and more and more across the Network Rail estate. London Bridge phase 1 is opening up imminently, and we see ourselves having 3 or 4 spaces, including a permanent MPK space in that area. The opportunity, if I was a betting man, I would say that we could, if not double what we're doing, then get pretty close to doubling what we're doing over the next 18-month period. That is from the release of more space, us being a lot more savvy as to what you can and can't do, and the release of opportunities into those spaces are are becoming more and more self-evident to us. So we are very comfortable regarding the opportunity of Network Rail. And I've forgotten the first caveat of that
Just
question.
on visibility of revenues.
Visibility, yeah, I mean, we are back end of the year orientated. That won't be helped by the POP retail just-in-time program. However, that is mitigated by the MPK program, which we are operating. So, for example, in the last 3 months last year, we had forward bookings for October, November, December of £100,000. This year, we've got forward bookings of £350,000. So the fact is that this product is producing a higher margin and giving us better over-the-horizon stuff. And next year, it will be even higher than that. So what we're seeing is, particularly in UK and in Germany, Christmas is booking later and later and later. We've responded with the just-in-time POP retail program. Although we see there always being issues with over the horizon, some of the new products such as MPK will mitigate against that.
Okay, and we've just received, it'll have to be the last question from Mark, I suppose related to the previous question. Does that short-term nature mean you have less longer-term contractual links with clients, and could you remind him what the duration of the agreement with Network Rail is?
The Network Rail is 5 years. We're just coming to the end of the first year, so we'll have another 4 years to run on the Network Rail contract. Typically, most of our contracts are between 3 and 5 years with our property developers, and although it doesn't affect our longer-term nature of the relationship with the property groups, what we are doing is responding to the short-term demand by customers at strategic parts of the year. To do that, you need the products for it. We are very much more a product-orientated solution company as opposed to just a service solution company, and that enables us to control our earnings and control, if you like, incentive control, sale price control, lots of things which you can't do when you're just a broker. When you're a principal, which we are with both the MPK and the POP retail, then we have got a lot more control of the business.
Great, well that concludes the presentation. Thank you very much, gentlemen, for your time and your clear answers.
Thank you.
Bonne chance on your business trip tomorrow, and thank you to our audience for the perceptive questions.